Hello and welcome to this knowledge sharing series. I'm Tarun Mahajan, a chartered accountant and more a registered valuer. I'm doing valuation assignments on all types of securities or financial assets, however complex or however simple it is. When it comes to valuation, it interests me a lot. And I'm here once again with you to share, to discuss on the matters related to valuation. The purpose of this session is not to give legal advice to anybody. This is how I interpreted the law. If you have a different opinion or if you would like to supplement what I'm saying over here, just feel free to connect to me at the email ID tarunmahajanca@gmail.com or at my mobile number on WhatsApp at 9893040600. So you're already aware that there is section 5627B of the Income Tax Act 1961, which says that if any unlisted company is making allotment of its shares at a premium, then if the issue price is more than the fair market value, the difference amount is taxable in the hands of the assessee. But the question is, who will calculate fair market value? So this question is already answered by section number 5627B itself. There is an explanation to the section which says that for the purpose of this clause, the fair market value of the share shall be the value as may be prescribed. Now, what is prescribed? That is rule number 11 UA. Subrule 1 is mostly for transfer of shares and securities, and subrule 2 is for valuation in case of allotment of securities. Earlier, subrule 2 was giving only two choices to the assessee for valuation of its equity shares only. That is, one may be named as book value method, and another one may be discounted cash flow method. Book value method never required any certification by anybody, but people used to get it certified by a practicing chartered accountant. And DCF earlier, it was allowed to be done by merchant banker as well as chartered accountants, but few years back they amended it, and nowadays only merchant bankers can do the valuation. So from 25th of September 2023, existing subrule 2 has been replaced by a new subrule 2. And the interesting part is, earlier this subrule was only for valuation of unquoted equity shares, but now this is there for not only for unquoted equity shares, sorry, it is not only for the unquoted equity shares, but also it is there for the unquoted compulsorily convertible preference shares. But let me tell you, this section still, I'm saying section, this subrule still does not cover optionally convertible preference shares. So if a company is issuing equity shares, valuation should be done as per subrule 2. If a company is issuing compulsorily convertible preference shares, that is CCPS, valuation should be done as per subrule 2 of rule 11 UA. But what if a company is issuing optionally convertible preference shares, OCPS? Some people give it creative names also. Some people may call it, sometimes a convertible note or the safe instrument or the I safe instrument, or there may be different names. But what about the OCPS? It is still not covered over here. So I guess it will continue to be governed by subrule 1, clause C, subclause C, that is 11 UA 1CC. Okay, that's fine. But let's talk about how to do valuation of equity shares and CCPS in subrule number 2. So earlier only two ways of valuation were allowed. Those two are still there. The first one is the fair market value of unquoted equity shares will be A minus L. Here, when I say A, it is book value of assets in the balance sheet. So when I am transferring shares, whether from the point of view of seller or buyer, if I'm looking at the transaction, I'm still governed by Rule 11 UA, Subrule 1, Clause C, Subclause B. 11 UA 1 C B I'm governed by. And it says the value is fair value at the time of transfer is A plus B plus C plus D minus L. And there it says that immovable property should be taken at the stamp duty value. That is the fair market value. Even investment in other unlisted companies, investment in other companies should also be taken at the fair market value as per these rules. But when it comes to that means the value for the purpose of transfer will be comparatively higher and the assessee will have to pay more tax on transfer of shares. But when it comes to allotment of shares, they say no, don't take the stamp duty valuation of the land and building and don't take the fair value of investment in other companies. Take everything at book value. So mostly which will result in a lower book value. And if you issue shares at a higher price, the difference will become taxable in your hands. So it's a win-win situation for the revenue, both sides, and it's a lose-lose situation for the assessee. Anyways, this method was already there, A minus L, and this method will continue to be there. Book value of assets, and then you deduct book value of liabilities, and kind of you divide it by number of shares, and then you multiply by number of shares which are being issued by the company. It does not require certification by anybody, but as a practice, people take report from certificate from practicing chartered accountants, and even now they have started taking report from a registered valuer because nobody's certification is required, so anybody can certify it, including the registered valuers. Now, this second method, this was already there and it is still continued. That fair market value will be calculated by the discounted free cash flow method, but unfortunately, it can be certified by a merchant banker only. And they, I mean, there was news that even the registered valuer should be included over here because they are the experts. They know it very well how to do the valuation. They are doing it day in and day out. If you ask me what is the core business of merchant bankers, valuation is not their core business. Yes, they also do valuation. But if I talk about registered valuer, they are trained and regulated for that only. And unfortunately, the registered valuers are not allowed to do DCF valuation under the Income Tax Act, here under Rule 11 UA to B. And that continues. There was an opportunity with the government that while making amendment in these rules, even the registered valuer would have been added in addition to merchant banker. But unfortunately, this is not done. Okay, now coming to the new points, C, D, and E. So what is, now you have one more way to prove your valuation. Now, this is a relief for the companies which are raising funds. They won't need any certificate even from the merchant banker or from anybody, because what they are trying to say here is that if you are making issue of your shares either to a venture capital fund or to a venture capital company, when I say venture capital fund or venture capital company, it means it's a venture capital fund or a venture capital company which is registered with the Security and Exchange Board of India, right? And also, if you are getting money from any specified fund, so when I say specified fund, then section itself says that you are a category 1 or category 2 alternative investment fund, which is regulated by the SEBI AIF regulations, or you are an AIF which is regulated by the IFSC AIF regulations, International Financial Service Center regulations. Venture capital fund, venture capital company as defined in 23FB of section 10. Again, those are SEBI regulated entities. Many times, even the angel financiers and some other people, loosely they say we are venture capitals. No, venture capital, when I say, it must be registered as a venture capital. So if you have received money from venture capital fund or venture capital company or specified fund, first of all, this is exempted from section 56 to 7B. If you receive money from these people, so you actually, where it is written that it is exempt, it is written in the section already. Look here. This clause is not applicable if you are receiving money from venture capital undertaking, venture capital company, or specified fund, that is alternative investment fund, category 1 or category 2. So this is already exempted. But now what we are saying, if I am making allotment of my shares, say the 10 rupees face value share, I am allotting at a premium of 490 rupees, that is my issue price is 500 rupees, and I am making allotment to the venture capital fund. I have allotted them 1 lakh number of shares at 500 rupees per share, that is 5 crore rupees of the fund I raised. Now, from the date of issue of these shares, in the next 90 days or 90 days before, that is a total 180 days time span. If I am making allotment of my shares to anyone else who is not exempted from 56 to 7B, then I can say that I can make allotment at, I will take that 500 rupees per share as the fair value, right? But there is a condition. There are two conditions, in fact. Let's read. The price of the equity share corresponding to such consideration may, at the option of such undertaking, be taken as the fair market value of equity share. But the condition is, to the extent consideration from such market value does not exceed the aggregate consideration received from VC or specified fund. So if I have raised 5 crore rupees from the venture capital fund, and within 90 days or 90 days before this raising of the money, if I am making allotment to someone else, 56 to 7B is not exempted. But I won't have to take a fair market value certification from a chartered accountant or from a merchant banker. I won't have to take. I'll say, look, if venture capital is ready to subscribe at 500, that means my fair market value is 500. It's my choice. I can choose clause number C. Oh, okay. Now your fair value is 500 rupees. We consider it as your fair. But that means either you can issue shares at this price or below this price. If you issue above this price, then the difference amount will become taxable in your hands, right? But another condition is you cannot raise the money more than the money you raised from venture capital. So that's very thoughtful provision. Otherwise, I would have raised 5 lakh rupees from venture capital at 500 rupees per share, and then I issue share at 500 rupees and raise 10 crore rupees from someone else. So that's not allowed. If you have raised 5 crore rupees from VC or specified fund, then to be covered in clause C, you cannot raise more than 5 crore rupees from other people. But what if I issue shares at 400 rupees? That's fine. You can always issue at a lower price, and then you will be able to issue more number of shares. We are here talking about the consideration, not the number of shares. "90 days before and 90 days after." But what if I make a VC round at 500 rupees, and after 60 days, I'm making allotment to some other people, and I say, look, I'll give you shares at 600 rupees, because after VC came in, uh, I have started getting more respect in the market. More suppliers and more customers are approaching me, and that way my valuation has gone up now. It's no more 500 rupees, it is 600 rupees. In that case, you just don't follow this clause C, and maybe you can shift to clause B and get done the valuation by merchant banker, and now you can issue even at 600 rupees. But if you don't want to get done the valuation, you want to save on that valuation fees and exercise, then you'll have to stick that, okay, VC got it 500, so you can't issue at a price more than 500, and if you do, you'll be taxable. Interesting thing is before and after. So if you are expecting a VC round, say in next 90 days, and you already entered into, say, even a non-binding agreement, the VC, and the price has been determined, you can issue shares to other people at that price and you won't need the valuation to be certified. Okay, so this is a new way of proving your fair market value, that if VC is taking at this price, it means it is the fair market value. Exactly same thing goes true with clause E, but now it is saying not from the VC, but from the people who are notified under subclause under clause 2 of first provision to section 5627B. Look here. This is your 5627B, and this is the first provision, and this is the second clause, which says that 5627B shall not apply where the consideration for issue of share is received by a company from a class or classes of persons as may be notified by the central government. So has central government notified something like this? And the answer is yes. On 24th of May 2023, via notification number 29 of year 2023, central government has already notified that if you are receiving money from these people, then 5627B is totally exempted. Just like VC and AIF are exempted, receiving money from them is exempted. Similarly, this is also exempted. And there is a long list that if you are receiving money from government or government related investor, you are receiving money from banks or insurance companies, you are receiving money from foreign portfolio investors which are registered with SEBI as category 1 FPI, or the endowment funds of the universities, hospitals and charities, or the pension fund, or other pool vehicles which are there in the territories for which list is given here. I repeat, so if there are people, any of the following entity which is a resident of any country or specified territory. Look, earlier receiving money from any non-resident was exempt from 5627B, but now it has been changed by Finance Act 2023. So now look here, list of countries is given, and these entities of those countries, FPIs, endowment funds of university, hospital, charities, pension funds, and the broad-based pooled investment vehicles of those countries. These entities coming from these countries, if you're receiving money from over here, you're exempt from 5627B. If you read this list of companies, none of the Asian countries are there. Say China, if you're receiving money, no, you're not exempted. And none of the tax havens are included over here. Panama, British Virgin Island, Mauritius, no, only, Korea is there. I won't say none of the Asian countries are there, but the countries which are considered to be, where the entities are considered to be properly regulated and where the chances of manipulation are least, only those countries are named over here. So if you are receiving money from these people which are notified by on 24th of May 2023, that is already exempt from the provisions of 5627B. That's fine. That is exempt. But now the interesting thing is that if you receive money from these people, that will become a benchmark. That okay, you received money from these people, say at 800 rupees per share. Now you can consider that this is my fair market value. But again, the condition is same, that the money which you are receiving from other people should not be more than the money which you have received from this people. Okay. And then the same condition before and after 90 days. So if I'm receiving money from a foreign portfolio investor registered as category 1 FPI with SEBI and which is domiciled in United States of America, if I'm receiving money from that guy, so that is the exempt under 5627B, but I received money at 800 rupees per share, so that is established as my fair market value for next 90 days and for previous 90 days, and then I can make allotment to anyone else at this fair market value without obtaining a valuation report. But section, you don't get exemption that the company is receiving money from Tarun Mahajan also besides from that FPI. So you got money from FPI and after 30 days Tarun Mahajan is also investing money. So I'm not saying that this is exempt from 5627B, but you can issue to Tarun Mahajan at 800 rupees per share. Okay, now one interesting thing. Okay, so this is done, right? One more point, and which is applicable. Several other methods are allowed. But interestingly, this way of valuation is allowed only if you are receiving money from non-residents. So if you are receiving money from residents, you have only 4 choices: the book value method, which was there earlier also; the DCF method to be certified by merchant banker, which was there earlier also; the VC price benchmark, the specified company price benchmark. You have 4 methods. But if you are receiving money from resident, this 5th method is not available. There is clause D. This is available only if you are receiving money from non-resident investor. And what are the other things which is allowed? The fair market value of the unquoted equity share determined by the merchant banker in accordance with any of the following methods. Comparable company multiple method. I have a doubt in this. They are saying comparable company you can use, but the valuation people can understand it very well, that there are 2 things in the market. There are 3 approaches, right? Income approach, market approach, and the cost approach. So under market approach, you can use either the comparable company method or you can use the comparable transaction method. So does it mean that only comparable company method is allowed and comparable transaction method is not allowed? Or can we take a liberal interpretation that comparable transaction method is very similar to comparable company multiple method? Can we use that? That remains a question. On the safer side, you should try to avoid using comparable transaction method. I mean merchant bankers, because this can be certified only by a merchant banker. Again, unfortunately, registered valuers are not notified over here. Probability weighted expected return method. So usually in India, we don't use this method for the sake of valuation. I mean, I rarely use it for my valuation. We'll have one separate session to, discuss this method. Option pricing methods. Now, option pricing method can be, there are various methods: the Black and Scholes option pricing model, the binomial option pricing model, the Monte Carlo simulation model, the Back-Sol method. There are various OPMs. You can use any one of those, definitely. Milestone analysis method. This is again not a popular method. In fact, I talked to several people in United States of America also. Even these guys are not using. I don't know from where this method came in. And there is one more method, which is replacement cost method. So DCF was already allowed. This is the market approach, and this is the cost approach. Now, these methods are also allowed, but allow me to remind you that this is only where you're getting money from non-residents, and this is not these methods are not available when you're getting money from resident, and this can be certified only by a merchant bank. Ditto same thing goes true for CCPS also. But there is one more interesting point. As I said, OCPS are still not regulated by this sub rule. And another thing is that for CCPS, they are giving two choices. They are saying that these methods, 1, 2, 3, 4, 5 methods, suppose you directly apply some of these methods to arrive at value of CCPS, or first you calculate fair market value of equity shares using these methods, and then you arrive at market value of CCPS, fair market value. So what does it say? In accordance with the provisions of subclause B. Now, what was B? That is DCF by merchant bank. C, VC benchmarking. E, specified company benchmarking. So you can use these methods for valuation of CCPS. And it is choice of the assessee, obviously, that which method he would like to choose. Or, interestingly, based on fair market value of unquoted equity shares. Or you first calculate equity shares value and then CCPS value determined in accordance with A, book value, B, DCF, C, VC benchmarking, and E, specified company benchmarking. This is for resident. For non-resident, even the D method, that is multiple methods, that is also allowed. So a free hand is given over here. But interestingly, now they have introduced subrule 3 and subrule 4 also, where the date of the valuation report by the merchant banker is not more than 90 days prior to the date of issue of share. Such date may be at the option of assessee be deemed to be the valuation date. What does it mean? Once you obtain the merchant banker certificate, then and you are making multiple allotment of shares, then it is valid. This merchant banker certificate is valid for 90 days. Earlier, there was no such time limit. So this is more like a restriction. That suppose you obtain a merchant banker valuation. One more thing, where the date of valuation. There may be two interpretations. It may be date of signing of the valuation report. It may be the valuation date itself. And a logical interpretation is to assume it as the valuation date, not the signing date. So suppose today it is 26th of September and I obtained a merchant banker valuation and the valuation date is 31st of August. So now in the month of September and October and maybe up to 29th of November, yeah, I can use this merchant banker report, but in December, if I'm making allotment, this report is expired and now I'll have to get signed a new report. So that is kind of validity period of the valuation report. Okay. Now there is one more interesting provision and that's the safe harbor. What is safe harbor? Sometimes, especially this safe harbor is useful when your investors are non-resident. So you agreed at a price and maybe that price is agreed in dollar terms. And later there is a foreign exchange rate fluctuation. And now you are receiving more money. You agreed that you will receive $5 million and you received $5 million for specified number of shares. But by the time you receive the money, dollar become expensive and practically you are getting more money. So in that case, that's a problem. Now the tax department will say, look, you received more money than the fair market value certified. So now you are taxable. So the safe harbor says that whatever fair market value is there, suppose merchant banker certifies or the VC benchmarking is at 1,000 rupees. So up to 1,100 rupees, if you receive money per share price, that will be considered that, okay, this is also the fair market value. This is a nice provision so that some here and there will be actually allowed. So that was, I hope this discussion helped you, and just feel free to connect to me for any further doubts in this matter. Thanks.